MPW is down 75% over the last year. It's offering a yield of 18.4%. So is this a massive opportunity, share price growth with a high yield, or are you just throwing your money away? Let's take a look at the performance of the company. We'll take a look at why this has been dropping consistently. We'll analyze their top line revenue growth as well as their bottom line net income growth year on year, as well as their latest report we're expecting. We'll take a quick look at the health of this company, their total cash versus their total debt. Is there a chance of bankruptcy over the next few years? We'll also see whether they are the only company in the industry with this problem or it is industry-wide. We'll touch upon the institutional ownership. Are companies and institutions buying in the latest quarter? We'll discuss the dividend safety score, which looks to be very unsafe. They had a recent dividend cut last year. Will we see another dividend cut in 2024? We'll also take a look and run it through the insider buying or selling, and we'll touch upon why this company continues to drop even in 2024 after being hammered in 2023. Don't forget, we will run them through the valuation model. We'll get to the intrinsic value as well as our acceptable buy price given that investor margin of safety. And we'll look to Wall Street to see what they are forecasting for this company over the next 12 months. Now, before we jump into the company's performance, let's just take a look and see why MPW continues to sink. Now, Stewart is one of their top tenants. We're going to take a look now, and they have now hired a restructuring bank. And as I continually mention on these videos, there is a chance that MPW will cut their dividend again. We can see in the most recent period their stock price has dropped, and now they are the worst performing REIT stock on Wall Street. So we can see here that MPW has been one of the most embattled REITs in the US due to the wall of maturities as well as revenues rise. And as a result, we already know this, but they did cut their dividend and it has dropped over 70% in the last 12 months. So let's take a look at some of the reasons. Now, Stewart Healthcare, yes, they are a key tenant. In fact, one of the reasons why MPW is in trouble, as we've mentioned before, they do struggle to pay their rent. This has been the case for the past few months, and now we have seen in the more recent period MPW entering into agreement that saw it extend some of their financing to Stewart. Now, there are some reports which will be good news that they have hired a restructuring bank known as Alex Partners to look at some of their options and how they can move forwards with this company. Now, when we take a look, we do also note that Stewart has told MPW that they have had difficulty in their liquidity situation because of their vendor issues, and that is why MPW are working together with Stewart to help them. Now, let's take a look at the numbers. Not only are they looking or losing a large tenant, as we mentioned, one of their largest ones with a lot of backdated rent, but they are also facing huge maturities, and they will need to start paying billions from next year. 1.4 billion in 2025, 3 billion in 2026, and 1.6 billion in 2027. So something just to bear in mind. I have mentioned it before, there is a likelihood that the company will cut its dividend once again, and given the fact that the dividend yield is over 17%, it could be very, very likely. Now, we'll answer this question throughout our video, whether or not this company is a good stock to buy. So let's take a look. Down 75% over the last year. Over the last 10 years, again, very similar, down 74%. Although we can mention that this doesn't include those dividends reinvested. Nonetheless, very, very poor. All-time high sitting around $24 at the beginning of January 2022. They are effectively at their 52-week low, very high yield, and a forward PFFO of 2.13. So on the top line revenue, now we do look 5 to 10% growth year on year, 800 million in 2018. 1.6 billion in 22, and it is expected to drop in 2023. So yes, it has increased over the last 5 to 6 years, and we do know increases year on year, but we can also say that 2023 they are expecting a drop to the top line. One thing that we also want to mention when looking at their revenues, just because the company has very high revenues or are increasing year on year, if they are unable to get that rent from their tenants, then that is a big red flag, because ultimately it means that that revenue will have to be written off and that bottom line net income will be smaller than what they had anticipated. 1 billion in December 2018 then on the net income, 903 million in 2022. Another red flag, their bottom line has been decreasing over the last 5 years. 2023 expected negative 33 million. So lots of things just to be wary. Look, it doesn't necessarily mean it's a bad company to invest in. It just means you need to be aware of all of these red flags before deciding whether or not to buy. Cash and equivalents, we can see 821 million in 2018, 340 million in their latest quarterly report. So they're holding less than half the amount of cash than they did have effectively 5 years ago. Now, comparing it to their total debt numerically and directionally, it has gone from 4 billion to 10.1 billion. Again, whilst this isn't a massive red flag just off the bat, it is something to be aware of that REITs do typically have their debt position increase year on year. There are several reasons for this, so we wouldn't say it is a massive red flag just yet, but we'll look at the net debt to EBITDA metric. So looking at some of these companies in the healthcare REIT industry, we can see over the last year that MPW has been the worst performing. Now, this includes dividend reinvested. You would be down 71%. But we also note that the vast majority of these companies in this sector have also had negative growth. Now, when we extend that to the last 5 years, MPW is down 74%, again including dividends reinvested, but also important to note that this industry as a whole has just been performing very poorly. So whilst it isn't isolated to MPW, MPW is the worst performing. But as I mentioned, past performance isn't necessarily an indicator for the future. 76% then of institutional ownership, and whilst 802 million worth of these institutions have been selling their shares, 1.25 billion worth of inflows have come. So institutions have been buying more shares than selling, and we note though in the latest quarter, Q4, they have sold more shares than they have bought. So a few different factors to digest just there. In terms of insider trading, we did run it through the buys and sells over the last year, and we can see there is nothing to note on this part. So in terms of dividend safety score, it is sitting at 20. It is very unsafe. Market cap just under 2 billion. It is a small cap company. Now, in terms of the latest recession, 07-09, they cut the dividend during that period. They did have above average growth, however, but they massively trailed the S&P, negative 76% return versus the S&P's negative 55. Dividend growth, everyone knows, negative 48%. They did have a dividend cut in August 23. Last 5 years and last 10 years, however, on average, it has grown by 4%. No surprises there. They have 0 years of dividend growth streaks. Now, in terms of dividend yield theory, yes, it states the company is undervalued when the current yield sits above the 5-year average, but when it gets so high and astronomical, you could say that it is fairly speculative. We do also note the forward P to FFO is 3 versus the 5-year average of 14.3, and the real estate sector P to FFO is much, much higher at 13.7. In terms of the free cash flow payout, yes, we do typically look at this, but for REITs, it's more volatile. We focus on the adjusted funds from operations. What we note for medical building REITs, 95% or lower. Only 1 year it did go above that, and in more positive news, 2023 it is expected to be 76%, 2024 at 55%. So this doesn't look too bad when you look at that 18% dividend, but we will consider the debt levels shortly in this metric analysis. Adjusted funds from operation per share, well, in better news, it has been increasing over the last 10 years. Yes, it isn't consistent, but it has been moving in the right direction. Although two things to note, 2023 it is expected to drop, as well as 2024 down to $1.09, so do factor that in. Adjusted funds from operation per share growth, you do want to see this go up because without this information, the sales growth can be fairly meaningless. So we do know that even though for a very strong period they have had double-digit increase to their top line, the last 2 years have been very weak, as well as the adjusted funds from operation per share growth. So unless they do start turning this around in the near future, then these could look like some very big red flag indicators. So when they do release their next annual report or quarterly report, we will run through their forward guidance. Now, numerically, their top line has gone 250 million to 1.58 billion, but as we discussed earlier, it is expected to drop to 1.42. In terms of shares outstanding, very typical for REITs, they do dilute your position, some faster than others. 150 million in 2013, just under 600 million in their latest report. ROIC for essentially REITs, we look for 3 to 5%. It does give us faith that management are able to effectively allocate their capital. Up to 2022, it looks fairly positive. 2023 expected to drop down 3%. Now, it's not the worst. It's at the bottom of the metric we look for, but just keep in mind we don't want to see any lower than the 3%. Operating margin looking very healthy at around the mid-60s%. Now, it did drop massively in 2023, so we do need to be wary of this moving forwards. And as I mentioned earlier, this operating margin obviously is based off of that revenue, but if Stewart Healthcare are unable in the future to pay that rent, then a lot of that numbers will become meaningless. In terms of the net debt to EBITDA, now this is one of the reasons why I see a dividend cut coming very soon. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. It shows us the balance sheet strength as well as dividend safety. 2022, it would take them 7.54 years to pay off all of their debt net of cash on hand. Maximum we want to see, in fact, is below 6. 2023, 8.33. 2024, just below 9. I am very confident that we will be seeing a dividend cut, whether that is this year or the beginning of next year. It does look like the words are written on the wall. Now, when we take a look at the valuation, as always, if you enjoy the content values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. We jump through the first model. Now, Graham's valuation, we don't typically use it for REITs, but just to let you know, the earnings per share for the trailing 12 months is negative. So if we were to look at that, we would take the average of the last 3 years. So let's jump into the first model, the multiples valuation. We have companies in a similar sector and size, their average P to AFFO with that of MPW. Now this gives an intrinsic value much higher than the market value. So we have our first sign of undervaluation. Just bear in mind we're not looking at any of these models in isolation and we will draw conclusions towards the end. Now, dividend discount model, the average growth rate is negative 7.5% given that essential dividend cut we saw last year. Now, forward looking, I've gone 0%. I would be very surprised if they do increase it. So that is a very middle opinion there. You could argue, in fact, it should be a negative, or in fact, it should be 1 or 2%, but we've gone for the middle there. Intrinsic value, then we have that undervaluation signal. And the third model, we have the DCF model, free cash flow year on year. Average growth rate, 97%. Forward looking, we've gone negative 2%, slightly more conservative than analyst estimates. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. Again, we have a third sign of undervaluation. Now, the intrinsic value for MPW in today's episode is just the average of these three models. And as always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. Margin of safety then, we use 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now for MPW, there are a lot of risks, so it really depends on what your risk-reward ratio is like as an investor, what your thesis is. But we can see, based on these numbers that we have run, there is a significant amount margin of safety. It's not quite there at 70%. When we look at 65%, it is pretty much there. So whilst we see a 65% margin of safety with MPW, it doesn't mean that we say that this is a buy. In fact, for me personally, this isn't one I'm looking to invest. There are a lot of risks with this company. If one of your largest tenants is going through a lot of rough issues and they are inevitably unable to make that payment, then we could see this becoming very, very troublesome for them over the longer term. In terms of the dividend cut, again, I did mention I would see them cutting their dividend, whether it's this year or the beginning of next year. In fact, as an investor, if I was someone who was an investor, I would say that is good news so that they can focus on bringing that debt level down and focusing on other areas of their company. Now, in terms of Wall Street and what they forecast, they see upside of 48%. They have much lowered their forecast. Before, we were seeing a much higher number, but nonetheless, they do still see it as 48%. Whether or not that is a buy, again, that does come down to your individual risk profile. As always, let me know your thoughts in the comments below. Is MPW a company you're looking to add? Maybe you've got shares and you're waiting to sell, or maybe you're looking at that yield and you think that it is sustainable and are adding more. As always, if you enjoyed the video, smash that like button. I'll see you on the next one, and for now, take care.